Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience, we will discuss our favorite topics, concepts, and stories.
Hello, welcome to the Joss Brown Wealth Advisors Podcast. I'm Phillip Saunders, and today we have Dan Joss as well.
I'm Dan Joss. We have Phillip.
We're both here. We'll be talking about the investment philosophy today. To start out, we have our investment philosophy in front of us, both of us do, so we'll just kind of go through that and talk about how we do it.
Yeah, lots of people want to know how we invest. So we usually have a meeting or two about our philosophy and then apply that philosophy to whatever it is they have.
Yeah.
Rarely is it one account. It could be 7 or 8 accounts for various reasons. In McLean, there was 4 investment advisors on the panel. And I think by the end of the hour-and-a-half meeting, we heard those 4 advisors give about 6 or 7 different investment philosophies.
Yeah.
So
I'm sure they did.
So we have a philosophy.
I've got 3 or 4 myself.
That's right. That's right. And that's when you are looking for an investment advisor, one thing you should be looking for is their investment philosophy, and not just say, manage our stuff for us. You want to know what they're going to be doing. Yeah. And a good advisor would give you that, like we think we are.
Yep.
And we start off by saying there's 2 main investment asset classes: stocks and bonds.
There you go. So
what do we look for in bonds?
Stability and income. So we look for short and intermediate bonds. That way, when interest rates go up or down, they're not as affected as would be longer term bonds. And we saw that last year, 2022, when interest rates rose, those long bonds got clobbered and ours just stayed the course.
Right. So the first rule is bonds are stability. And arguably 5 years ago, there was no income in bonds because rates had been kept so low. But now there's a little bit more income. But stability was the reason we invested in bonds. Yeah. And you could look at it like brakes, gas and brake pedals. Stocks are the gas pedal, bonds are the brake pedal.
Yeah.
And so if the and I remember back in 2008 when the stock market dropped 40%, we knew about how much bonds were in a portfolio based on how much the portfolio went down.
Yeah.
So if the portfolio dropped 20%, we knew that portfolio had about half bonds and half stock.
Yeah, another way people describe it is like the ballast kind of keeps things steady as you go along.
Yeah. And so one way to reduce the risk of a portfolio is to have more bonds, arguably more short-term and intermediate bonds, not more long bonds, like you mentioned earlier.
That's right.
And so a shorter bond reduces rate, but also a higher quality bond reduces risk.
Yep.
Because some people say we want high-yield bonds, or we would call them junk bonds. And that is a way to diversify among the bonds you have. But because bonds for us means stability, it's not a way we would diversify bonds.
That's right.
By having higher yielding bonds.
Yeah.
Because we want steady income and have pretty good assurance we're going to get our principal back. And you don't quite get that with a high yield bond.
Yeah, and so that means either high yield corporates or else some people would say government as well.
Sure, there's high yield governments.
So you kind of use both.
Yep, there's governments out there that may not be around to give the principal back.
Yeah.
The U.S. has a taxing authority and a fairly good reputation about paying their bonds on time. And other countries aren't as trustworthy.
Yeah, that's right.
So that's fixed income. And I'll use the terms fixed income and bonds interchangeably.
Yeah.
And what we do when we have a bond is we're loaning money. Right? We loan money to a corporation, or we loan money to a government or a municipality. We get payments, interest payments back, and then we get principal, and then we do it again. And we could own bonds individually, or we could own bonds in the form of an ETF or a mutual fund. But those rules still apply. We want short-term, intermediate term, high quality. If we own international bonds, we hedge so we don't have currency risk. And we're good to go.
Yeah, and another part of that might even be cash at this point or money market.
Cash is the shortest term.
That's right. Like
highest quality.
There you go. Last year the bonds were down, but cash was not down. It was maybe even up last year, and it's certainly up this year.
Yep, and now we can get 5% on cash.
Yeah.
The other asset class I mentioned, investment class, is equity or stocks. And I'll use those two terms interchangeably, stocks and equity. Equity is ownership in a company. And I remember when we were raising our kids teaching about stocks and bonds, we gave them a share of McDonald's stock.
Yeah.
So they got dividend income. They got their income from the dividend of the company, and then they watched the stock go up and down, which was changed every day on the stock market.
Yeah.
The value of what people thought their share of McDonald's was worth.
It's pretty cool.
But what we do here, what capitalism is the creation of wealth with someone's idea, someone using our capital or our investment money, someone putting together some raw materials and some labor and creating something or providing a service, and that increases wealth.
Yeah.
And so as capital investors, we're buying part of a company that will provide a good or a service, and if that company provides a good service or a good product, they benefit, and the price of the stock goes up, and then we benefit from that by sharing in the profits. And if it doesn't meet a need in the market, then it goes out of business and we lose.
That's right.
So a company can go out of business, but all the companies won't go out of business.
Yeah.
So we invest in large, small, growth and value companies, mid-companies, or mid-sized companies in the U.S. and outside of the U.S. 50 years ago, the U.S. stock market was about 70% of the worldwide market cap. And even, I think, 20 years ago, it was about 50%, 55%. Now I looked, and it's about 60%.
Okay.
So international companies have grown. It's not all Coca-Cola or Pepsi or Ford. There are foreign companies.
That's right. Samsung.
Nestle, chocolate.
Nestle, there you go.
So companies outside the U.S. do too. Companies outside our country also do well.
Yeah.
And we like hundreds of companies, not just 5. Now you took vesting in college, right?
Yeah. Well, as you always say, it was much different than the way we practiced investing. I mean, what we did in college was valuing stocks, individual stocks.
Right, but how many stocks was enough to diversify?
Yeah, they never got around to that. So
I think I've heard it's 40 or 50.
Okay, yeah.
But we're going to invest in lots of stocks. And
Yeah.
we would argue people don't know the future. Is that a pretty safe assumption?
I would agree with that, yeah.
But we've seen research that shows active managing, either picking the right stock or picking when to be in or out of the stock market, is hard to do, and it's hard to be profitable doing that. And so for the starting off investor, we're going to own the index, own all the companies.
Yeah.
And tilting towards small or tilting towards value or profitable companies is better in the long run.
Yeah.
But there are times where each of those assets, large, small, growth, or value, outperform the other.
That's right. Yeah, and short runs, they might outperform the other, but we say over market cycles, those value and small premiums will outperform over time.
And some of that is obvious, if you think about it. The best companies have the best people, and they cost the most, and then the return isn't as good. Just like
Okay.
A really good bond doesn't return as much as a riskier bond.
Yep. Because people are willing to pay more for that.
Right.
Yep.
And so that drives the price up.
Prices
And
up.
that's why you'll see on the stock news, earnings disappoint. It's like, well, they thought it was going to be this because everything was the best.
Yep.
But
That's right.
we didn't get it.
Yeah.
And value stocks or inexpensive stocks don't have that expectation priced in.
That's right.
And so when the profits show up, it shows up.
Yeah.
Last year, Hormel did pretty well, and they did pretty well in '08. And they just make Spam. I mean, they make a bunch of other things too, but there's no high technology that's going to change
That's
the
right.
world. It's when times are bad,
Spam's
people
been
are
around
going to
for a
buy
little
that. That's right.
Yeah, I've got a note here about the difference between value and growth companies. Some value companies would be companies like Berkshire Hathaway, ExxonMobil, United Health Group, Johnson & Johnson, Procter & Gamble, and actually, surprisingly, Meta is a value company. Some growth companies would be Apple, of course, Microsoft, Amazon, Google, and Tesla. And so that's kind of where we're at right now in the stock market. But those value companies are generally the ones that are maybe a little bit underpriced, as you said, relative to where the rest of the market is, and we're hoping to buy it low and just like everything sell high.
And beyond that, because of our discipline of rebalancing, we may be buying stock and selling bond because that is recently outperformed. So not just
That's right.
buy low and sell high stocks, but we look at the total portfolio and see what's under target or over target.
That's right. Yep.
And you mentioned those are the stocks right now that are growth and value. But
Correct.
A decade ago and 20 years and 30 years ago,
They've changed over time.
different companies were at the top of the S&P
Yep.
500. And it's interesting to watch that change.
Yeah.
Over
Like
time.
I'm sure Sears was one of those at some
Sears and
point.
Roebuck
and
was
That's right.
was the hottest retailer in the country.
Probably Motorola too.
Yep.
So changes over time.
Alternative investments kind of goes beyond just the two that we've mentioned, stocks and bonds. And alternatives are things that are either by design a little bit different or just aren't straight a stock or a bond. And so those are real estate investment trusts, commodities, natural resources, convertible bonds, and then there's a bunch of other kinds of investments, merger arbitrage, long, short, alpha only, all kinds of other investments that have come along to try to get return without the risk.
Yeah.
And so sometimes we include those in the portfolio, sometimes we don't. We look to see what's new on a regular basis, and then we either include it in our clients' portfolios or not.
Yeah.
But there's always going to be something new, particularly after a bad time in the market. It's usually a engine or a cause for creativity.
Yeah, yeah. And if you try to get too cute with it too, sometimes individual investors can mess that up and try to jump in and out of those things, like real estate, like energy, those different things. But we try to stay invested for the long haul. So when those companies are underpriced, we're buying, and when they've done well over time, then we're selling.
Yep. And which is we'll have a podcast in the future about the psychology of money. It's a whole nother complex. So stocks and bonds, with bonds providing ballast. Alternatives are different, and so they need to be handled differently, but they're part of our clients' portfolios, and then rebalancing periodically.
Yeah.
So let's talk rebalancing a little bit, because that's a main part of our philosophy.
Yeah, so rebalancing, we're doing that consistently in our client portfolios. And what that means is, as I've been saying, whatever's risen over time, we're trimming those gains. And then the things that maybe haven't done as well recently, we're adding to those. And, of course, we're realizing gains on what we've done well with. And so we're grabbing that income from those stocks and holding on to that. And then what we're expecting to do well in the future, we're adding money to that now so that it will do well in the future. That also lowers the risk of most portfolios, especially in, I'll call it a normal market when stocks are gaining.
Right. If we want bonds to be at half of the portfolio and stocks do well, then now bonds are less than half the portfolio.
That's right. So then the portfolio is more volatile. So we'll sell some of those stocks and add to bonds. Yeah.
And then we like to do rebalancing trades in the IRA where there's no tax consequence.
Yeah, that's right.
And we like to add to asset classes that are under target with new money. So 401k contributions or an inheritance or just regular after-tax money coming in to the portfolio. We add that to what needs to be bumped up in the allocation.
Yeah.
And the opposite is true. In retirement, we're spending money from the portfolio. So we trim what's above target or what has done well recently.
Yeah.
And use that money instead of adding it to the underweighted part of the portfolio.
Yeah, that's right. Yeah. And that's something, we listen to a podcast that goes into the distributions in retirement, and that's where you really need all those different asset classes that we went through, stocks, bonds, and alternatives. And those are the portfolios that last the longest throughout retirement as you're taking those distributions.
Yep. Good. Well, that's a good overview.
Yeah.
What do you think?
I think so. It sounds like you've been doing it for 20 years, so it's worked this far.
Next time we're going to be talking about an article we read and some other things that kind of get into the specifics of the philosophy, and we'll talk about how it applies in specific situations.